Good morning, friends. I am Deepa Khatri, Deputy Director at ICSI. On behalf of ICSI, I extend a very warm welcome to all of you at this 5th session of ICSI Capacity Building Initiative, that is the Companies Act 2013, Enable, Evaluate and Excel. The topic for today is deposits and debentures for companies. In this session, we will cover about the meaning of deposits, what all are not deposits, deposits as an instrument of funding for financial entities, deposits as an instrument of working capital funding, amounts received in trust, advances against goods and services, installment schemes for purchase of goods and services, intercorporate deposits, etc. We will also discuss about the law relating to secured, unsecured, convertible and non-convertible debentures. To discuss this, we have with us the personality who needs no introduction, Mr. Vinod Kothari. Welcome, sir.
Thanks,
Mr. Kothari is engaged in practice of corporate laws for over 25 years. Vinod Kothari is internationally recognized as an author, trainer and consultant on specialized financial subjects, namely housing finance, securitization, credit derivatives, accounting for financial instruments, structured finance, banking regulations, etc. He has addressed various seminars on these subjects at New York, Washington, London, Singapore, Hong Kong, Sydney, Dubai, Egypt, etc. He, along with his team, has handled various diverse groups, from rating agency professionals in Malaysia to groups of investors in Sydney to tax officers in South Africa to group of lawyers in India. We welcome you, sir, at this session.
Thank you.
We also have with us our Central Council member of the Institute, Mr. Ranjit Pandey. Welcome, sir, who is also chairman of PMQ course committee. I hope this session will enlighten the viewers and clarify the doubts on the topic. I would now request Mr. Pandey, council member of the Institute, to take over.
Good morning, friends. Welcome you once again to this series on Companies Act, Enable, Evaluate and Excel. Friends, we have already had 4 sessions on the various topics of the Companies Act, and as I have told you in the initial session, opening session itself, that it will be more of a transaction based topics rather than going chapter by chapter. So we are not going chapter by chapter, we are mixing and merging the topics, and response from your side is tremendous, and definitely participation is very encouraging and motivating for all of us. All 4 topics which has been discussed has been uploaded on the ICSI website, and link has been shared to all the members who has participated and even those who have not participated. So I'll request all of you to kindly participate during the session. Of course, you can watch the session later on also for the purpose of further clarification and further clarity. But one benefit here live session is that you can ask your questions and concerned question can be replied by the speaker. So last session on the related party transaction and of course SS2 had certain queries and it has been answered then and there. But on the related party transaction, some of the queries has remained unanswered due to paucity of the time, because that session has extended beyond 2.5 hours. So what we have done, we have sent that those queries to the speaker, and she is coming back with the answer to those questions in the FAQ form, and those FAQs will be shared with you, and definitely it is going to help you out in the future transactions. Friends, we have with us Mr. Vinod Kothari, and he has divided various topics into various subtopics, and one subtopic will be over, then we will be taking the query in between. So keep writing your concerns and queries during the session. ICSI officials will collect all those queries and bring it to here, and I will definitely read out those queries for Mr. Kothari, and then he will answer those queries. So keep watching the session and do ask your queries. Now over to Mr. Kothari.
Thanks. Thank you, Mr. Pandey, and Deepaji, thanks very much for nice words of introduction. My pleasure indeed to be in the midst of you all. And deposits and debentures. Now, one common question is, what's the commonality between the two? Debentures are a capital market instrument. Debenture is a plain method of funding. So why did we think of mixing these two topics into debentures and deposits? Now, what we need to understand in Indian perspective, is that many companies actually may not be raising deposits. They are not deposit raising entities as such. And when it comes to non-banking financial companies as well, most of the NBFCs do not raise deposits because the RBI has not permitted them to raise deposits. So the subject of deposits in India is relevant not merely from point of view of companies wanting to raise deposits, but because companies would like to know whether a particular method of funding used by them may actually tantamount to a deposit. Because the way the definition of deposit works in the law, even a financial instrument, even such as a debenture, may actually tantamount to a deposit, and that's why we thought of taking these two together to understand what debentures will fall in the purview of deposits and what debentures do not fall in purview of deposits, and therefore what all potential funding instruments can be deployed by companies without hitting the deposit regulations. So we will straight get moving first by understanding the nature of a deposit as a means of working capital funding and why companies actually in the past were using deposits as a mode of funding, and lately companies have mostly refrained from using deposit as a source. So when you talk about use of deposits as a working capital funding instrument, you could probably think of financial entities and non-financial entities. When I talk about financial entities, we are talking about non-banking, non-financial companies, non-banking financial companies, Banking companies are currently not within our purview. Banking companies obviously are primarily focused on deposit taking. That's the basic means of refinancing. Non-banking finance companies as well might have had an RBI permission to raise deposits, and therefore NBFCs also may be focused on deposit taking, particularly if they have a deposit license. But non-banking, non-financial companies raising deposits, now that sounds like a very typically Indian perspective, because world over, thinking of a non-banking, non-financial company reaching out to public and asking for deposits from public is very rare. It's rarely so that a non-banking, non-financial company would at all access public and ask for deposits. So this is a very uniquely Indian phenomenon. And as I mentioned in the presentation as well, that this is something which has a history. In 1960s, cotton mills in Bombay faced a working capital crisis, and the government allowed as a temporary measure for cotton mills to improve the working capital scenario to raise deposits from the public for a short term, as a short term funding instrument. And therefore what emerged as a temporary measure has actually continued through the years. And as I mentioned, during the 1970s and 1980s, lots of manufacturing companies were accessing deposits. Those who are slightly, let's say, senior in terms of age would recall that in 1980s and 1970s you would find lots of companies regularly putting advertisements in newspapers and trying to reach out to depositors to attract depositors with attractive rates of return. Now obviously, as one would expect, depositors were lured by the high rates of interest. Many of them were like pensioners or retired employees, or say even let's say very people with most ordinary means, and these people would actually put their life savings into companies with the lure of high rates of return. Eventually the company would default in payment of deposits, and therefore the people would be robbed of their life savings. Obviously this created a very unhappy situation for the depositors. It was a loss of life saving for them. It was a very unhappy situation for the government also, because government had a huge answerability issue here as to why the government allowed these companies to access deposits from the public if the companies were not safe. And over the years you could see the government, the RBI, everybody have been trying to discourage companies from raising deposits. Deposit rules have become more and more stringent over time so as to dissuade companies from raising deposits. As a matter of fact, with increasing institutionalization, increasing activity in the bond markets, you will find most large reputed companies have moved away from deposit markets, and you would not these days commonly find non-banking, non-financial companies at all relying on deposit as a source of funding. So this is something which we need to realize, that we don't necessarily expect companies to be raising deposits as a means of funding, and therefore the focus very often is whether my source of funding, I am raising funding let's say from a known source, it is not at all a public deposit, it is not even a public source at all. I am raising money let's say from my next door neighbor, I am raising money let's say from an LLP or a company that I know of. Is this by any stretch of law likely to be taken as deposit? So the relevance of studying deposit as a topic is not necessarily because your company is wanting to raise deposits or your client is wanting to raise deposit. It is more from point of view of ensuring that the money that you have availed, which may not be public deposit in your perspective, may actually by the sweep of definition of the law may be taken as a deposit. And that is where I think it becomes very crucial to understand the ambit, the scope of the term deposit. I will just come to that in a minute from now. Let me move on to non-banking financial companies. Non-banking financial companies, as one would expect, they are in business of funding, and therefore they may be tempted to raise deposits. However, over the last almost like 15 years, the Reserve Bank of India has not granted any new deposit license to NBFCs. So whatever deposit taking NBFCs we have are those which had a deposit license about 15 years back. Most of the 12,000 odd NBFCs in the country are currently not deposit taking companies, and mostly for every NBFC the RBI expects the NBFC to give a board resolution, a board undertaking that the company would not be raising deposits. So in other words, NBFCs may be deposit taking, however very few of them. Non-banking, non-financial companies may raise deposits, but mostly once again section 73, 76 etc. would regulate the extent to which companies may access deposits, and therefore the scope for real deposit taking for both non-banking, non-financial companies and non-banking financial companies is very narrow, and therefore as I reiterate, the relevance of the topic is more for understanding whether my mode of funding is at all attracting deposit regulations, because a breach of these regulations may be very costly. It may be very extremely penal in nature, because the relevant prosecution section is a non-compoundable section and has a huge penalty in terms of monetary fine as also imprisonment for several years. And the section talks about imprisonment and fine, and I am sure you all understand that when a section talks about imprisonment as well as fine, the section is non-compoundable. In other words, you just cannot escape criminal prosecution if you fall foul of the definition of law. We will be talking in course of our discussions today several funding instruments for NBFCs, non-banking, non-financial companies as well, which may potentially fall in definition of deposit. So I am just running through a quick list of these instruments just to give you a sense of what all we have to be discussed over the next 1 hour or so. We will discuss secured debentures, we will discuss optionally convertible debentures or compulsorily convertible debentures, non-convertible debentures with a ticket size of rupees 1 crore and above, non-convertible debentures, unsecured debentures with a lesser than 1 crore ticket size, hybrid debt instruments and subordinated debt instruments. These are instruments which are relevant basically for financial entities. These are typically issued for what is called regulatory capital requirement or capital adequacy requirements in terms of Basel II or Basel III. They are relevant for non-banking finance companies, they are not relevant for non-banking, non-financial entities. Commercial paper. Commercial paper is something which most companies these days issue. The idea of commercial paper basically is to reap a interest arbitrage. What do I mean by interest arbitrage? Currently, if you think the short-term money market rates of interest in the market are lower and your bank is not prepared to lend you at lower rates of interest, you could probably go to CP, commercial paper, issue commercial paper for a limited duration and thereby try to reduce your cost of working capital funding. So many large companies actually issue commercial paper once in a while, and that is commercial paper. Perpetual debt instrument also is something which is relevant for non-banking financial entities. This is also actually a means of raising tier 2 capital for regulatory capital purposes. Non-corporate entities. Now currently you would probably see that we are talking about Companies Act, and Companies Act we are concerned only with companies. However, a very pertinent question is, what about deposits raised by non-corporate entities? I am not even necessarily talking about unincorporated entities. Even for example something like LLP, a limited liability partnership, can it raise deposits? Can a partnership firm raise deposits? Can a proprietary concern raise deposits? Now these questions have been looming large over a long number of years, and mostly this was completely a blue sky because there was no regulation at all for LLPs or unincorporated entities. There is a new law which is soon going to be placed before the parliament, and I am sure in time to come this law will become extremely important law. The law has a long name, it is called Banning of Unregulated Deposits and Depositor Protection Bill. The text of the bill is already on Finance Ministry website, one could refer to the bill. The scope of this bill, whenever enacted, will be wide enough to cover LLPs as well as partnership firms of proprietary concern if they raise anything which could be termed as deposit. And surprisingly, even in this bill, the definition of deposit starts with a negative definition. In other words, everything is deposit unless excluded, and that definition, it's the sweep of definition which makes the instrument of deposit extremely important. So that's exactly what we come to right now as to what is a deposit. So deposit is defined by law to mean any receipt of money. Now looking at this, any receipt of money being a deposit, now this is extremely perplexing to say for a law that every receipt of money is a deposit. Well, we receive money in several cases for different purposes. We receive money, for example, let's say I receive money by way of my salary. Every month I get my salary, that comes in form of money. When I sell any goods or provide services, I get money. So can the law be meaning to say that every receipt of money is a deposit? Now that's where we need to understand that not every receipt of money could be a deposit, because several receipt of money could be by way of a sale of goods or supply of goods or services that by no stretch of argument could be taken to be a deposit. So what exactly is deposit? Deposit is actually what we call a money for money transaction. I get money, in return I will give back money, a money for money transaction. When I am receiving money to be repaid as money, I am receiving money to be repaid as goods, no question of deposit. I receive money to be repaid as services, no question of deposit. I receive money and I will repay money. That is what is by sweep of definition of law, that is a deposit, and such deposit, unless excluded from the purview of the term deposit, is liable to be covered by the deposit regulations. So as you can understand, this sweep of definition will include whatever is deposit in substance deposit, even if the contract is so designed that it looks like a transaction for purchase of goods. But even a so called transaction for purchase of goods may actually be operating as a deposit. You could probably find lots of such examples in the recently unpopular or popular West Bengal so called scam. It commonly took a name called chit fund scam. Now during this scam you found a lot of companies which were actually receiving money purportedly for sale of goods. One would for example agree to sell saris in future or sell rice in future and receive money, and when it came to the actual delivery date, saris were not delivered, rice was not delivered, money was delivered back. So this was, if you look at the structure of the contract looked like a purchase of rice or purchase of goods and services. However, in substance this was nothing but a contract. So in substance, a deposit. If the substance of the contract is receiving of money and giving back money, that's a deposit. Is it important that interest must be inherent? Normally one would expect in any financial contract, I am getting money, I must be paying the time value of money. So normally speaking, any such contract must implicitly have interest, but for being covered in definition of deposit, whether interest is there or is not there is not crucial. It is commonly so, however not crucial. Now look at some other extended meanings of the term deposit. I will come to this next point which talks about amount received from LLPs, but let me first quickly talk about the so called installment payment schemes. One would have noted a very common structure deployed by several entities, primarily the jewelry companies, where people pay money in installments. So you pay, for example, you're buying jewelry worth, let's say 12,000 rupees. You pay this 12,000 in installments. You pay 1,000 each month. You pay the 11 installments, and the 12th installment you don't need to pay. Now basically what's happening is you paid 11,000 and you continued paying that month on month. End of 12 months you get jewelry worth 12,000. So you get an additional rupees 1,000. You get it in form of jewelry. And a question therefore that was raging was, is this a case of deposit? We would see in the deposit definition of deposit, a definition called deemed deposit has been added in the deposit rules towards the end. The deemed deposit definition says that if any benefit is given to a person for participating in a financial scheme or payment of installment scheme, and this benefit actually is for the time value of money involved in giving of these installments, then the structure would be deemed to be a deposit scheme. There cannot be anything wrong in agreeing to buy jewelry or buy goods. One can definitely prepay for goods and buy goods later. In the world of commerce, it's so very often open that I order for a machine and the machine is delivered 12 months later. There's no stretch of logic to say that every prepayment for purchase of an asset is a case of deposit. However, we need to understand whether we are placing order for an ascertainable or specific asset or a generalized asset. For example, when I go for the jewelry case, am I paying money over the 11 months without knowing what am I going to buy over after 12 months, or am I buying a specific piece of jewelry? I identify bangles which I am going to buy 12 months later, and I am making payment in 11 installments for buying a specific set of bangles. This is definitely nothing but a contract for purchase of bangles. But if I continue paying money month on month without knowing what am I going to buy, 12 months later I decide whether I buy a necklace or buy a bangle or buy whatever else, that is definitely a case of deposit, because what basically you've done is you've done working capital funding for the recipient. A deposit after all is nothing but working capital funding. So one needs to understand that deposit need not necessarily be a technical structure of a loan. It may even take structure of a purchase of goods and services if in substance the transaction is operating as a money for money transaction. The intent is to receive money and provide money back, or a benefit in terms of money, then the transaction may still be regarded as a deposit. What is not a deposit? Now this is a very important I would say very important slide, because this is what tries to capture what otherwise is a money for money transaction, however not captured in the sweep of the term deposit. I repeat once again, very important to understand, every money for money transaction, money for money meaning I get money and give back money, in substance money for money transaction is a deposit unless excluded. What are the exclusions? A receipt of anything other than money. If I get not money but something in kind, for example, let's say I get goods, let's say I get services, no question of that being taken as money, because every deposit has to be first a receipt of money. Loans received from banks, financial institutions and mutual funds. Obviously when you are borrowing money from banks, financial institutions, mutual funds, there is no question of such borrowing being regarded as a deposit. Third exception, money received from a company. This is a very important exception, and the exact language of law says an amount received from a company, any amount or an amount received from a company. When we receive an amount or any amount from a company, two things we are talking about. A, we are getting money, it could be any amount, so any amount received from a company. However, the person placing the money with us is a company. Now this is a very important term. Supposing let's say I get money and I get it from an LLP, a limited liability partnership. I have got money from a body corporate, but have I got money from a company? Answer would be no. So if I am getting money from an entity other than a company, then the exemption under this particular clause, which is talking about any amount received from a company, would not be
externally convertible debentures only. We intend to talk about CCDs later at some length also, so I will move further from here and then move on to amount issued as secured debentures. Secured debentures are exempted. Secured debentures are exempted with the condition that the debentures are fully secured. When we say fully secured, what it means is that the value of security at least covers the par value of the debentures. So, the value of the underlying collateral covers the par value of the debentures, right. That is what is meant by fully secured debentures. Amount received towards subscription for any security, so called application money for allotment of shares. Now, the conditionality added by the 2013 Act is that we need to make allotment within 60 days. If we do not allot within 60 days, we need to refund the money within 15 days. You could probably also relate this to section 42, which talks about private placements. So, if you received something by way of application money for securities and we allot within 60 days, there is no question of the amount being a deposit, because the amount actually converts itself into a allotment of securities. If we do not, then within 15 days we need to return the money. If we do not return within 75 days, 60 plus 15, then from the 75th day the amount becomes a deposit, and that brings in therefore the entire deposit regulation. Let me just quickly take here an example to illustrate how the different exempting clauses may be actually used as alternative exemptions. Now, once again we go back to this particular clause which talks about subscription, application money for subscription to securities. Let us say my company receives application money for allotment of shares from my holding company. I am a subsidiary company. I receive an application for subscription to shares from the holding company, and somehow I fail to make allotment within 70. For a minute we are not discussing a potential breach of section 42, that is not our topic today. We may not even be concerned with section 42 because the transaction may actually fall under section 62(1)(a), but that is a different issue altogether. Focusing on the meaning of deposits, I receive money from a holding company to the subsidiary company and I do not make allotment within 60 days, I do not refund the money in 15 days also. So, are we saying from 76th day this money received from the holding company will become a deposit? The answer here should actually be no. Why? Because now we move on to the other exemption which talked about any amount received by a company from a company. That is to say, each of these exempting clauses are independent of each other, and the conditionalities in one clause may not be relevant to the other clause. For example, the clause pertaining to any amount received by a company from a company does not lay condition as to within how many days must I refund the money or whatever. It is simply laying important condition that I must be receiving the money from a company. As long as I got the money from a company, that answers the definition, that answers the conditions for the exemption, and that suffices. So, even same, for example, let us say if I raise money say by issuing optionally convertible debentures and the OCDs are issued to companies. OCDs are not an exempted category, there is no exemption for OCDs at all. However, if as long as the OCDs are issued to a company, the OCDs will also be exempted because that is a amount received by a company from a company. Next exemption, amount received in trust. Now, this is very often, I think people try to exploit this particular definition, whereas the scope for this is very limited actually. Amount received in trust, what is the meaning of amount received in trust? As a trustee, I am holding an amount. When I am holding something as a trustee, presumption is that I cannot use in my business. I am simply a trustee, I am holding something for somebody else. I can use that money only as per instructions of the beneficiary and not as per my discretion. In any case, there is no question of commingling the money with my own money. So, I can't make use of this money at all. So, simplest concept is wherever I am receiving money from it as a trustee, I must keep the money segregated and no question of commingling or applying my own discretion on use of money. When you receive money as a trustee, there is a very strong likelihood that some of the SEBI regulations might also get attracted there. For example, there is a regulation on portfolio management schemes, there is a regulation about mutual funds, regulations about alternative investment funds, collective investment schemes and so on. So, if you contend that you are actually holding the money as a trustee, you need to then answer whether the scheme amounts to a collective investment scheme or portfolio management scheme or a mutual fund in terms of SEBI regulations. We will shortly be talking about that as well. Next exemption, amount received for supply of goods and services. If any amount is received for supply of goods or services and the amount is not appropriated towards the contract within 365 days, then from the 366th day, that is after lapse of a year, the amount becomes a deposit. This is also a very commonly confusing clause, and a lot of people actually contend that if I don't supply goods or services within 1 year, then from the end of 1 year the amount becomes a deposit. Now my view is a bit different on that, I will just come to that in a minute from now, so I will just discuss that separately. Deposits received from directors and as per a separate exemption notification of the MCA dated 5th of June 2015, in case of private companies an amount received from a member, but there is a limit there to the extent of at least 100% of the company's paid up share capital, premium and free reserves. So, to within a limit of paid up capital, that is let us say net worth of the company, 100% of net worth of the company, amount received by a private company from its members will also be exempted. So, amount received from directors, amount received from directors' relatives in case of private companies, amount received from members by a private company within a limit of 100% of net worth. Amount received from an employee as security deposit, that is also exempted. So, this is pretty much, I will just quickly moving to the other exemptions. Commercial paper, I think we discussed already some time back. Commercial paper is a short term funding instrument. So, commercial paper also would get exempted. Other instruments which are permitted by RBI, that includes money market instruments, NCDs with up to 12 months maturity, share warrants. Why is share warrant not a deposit? Because share warrant actually is a pre-subscription for a future conversion into shares. A share warrant is actually an option to buy shares. Option lies with the warrant holder to convert the money into shares. Normally, every share warrant comes with a condition that there is a premium paid upfront. If the member decides not to get the shares, then the premium paid will stand forfeited. Promoters unsecured funding. If promoters are required to bring funding on stipulation of a lending institution, lending institutions quite often bring promoters contribution or promoters funding as a precondition for giving a loan. If loans are coming as per that stipulation, that also will not be a deposit. Collective investment schemes we will separately discuss. Security deposits. Now this is also another important exemption. Security deposits. Can a security deposit be called a deposit? Security deposit basically means what? There is an obligation of the person depositing the money which is trying to secure by putting a deposit. For example, an employee puts a security deposit, a dealer puts a security deposit, a contracting counterparty puts a security deposit. Most of the deposits are for any potential obligation that may arise by virtue of contract, to secure which the money is being put as security deposit. These also will be excluded from the purview of deposits. Amount received from foreign citizens, foreign corporates or foreign persons in accordance with ECB regulations. Of course, whenever receiving money from foreign sources, we need to understand that the amount is ECB, external commercial borrowing, and therefore this amount can be received only in adherence to ECB conditions. So, if you are getting the money in terms of ECB regulations, then the amount would stay exempted because that is one of the exemptions under deposit regulations. I would pause here to see if on the meaning of deposits, which is what we discussed so far, on the meaning of deposits, if you have any questions. I think several questions have actually come on the meaning of deposits. We will probably take up those questions which are actually on meaning of deposits and then we move forward.
There are 5-6 questions on deposit. Overall we have received 55 questions till now, but some of the questions you have already answered, like whether a private company can accept deposit from a relative of a director. Second one is, can a company accept deposit from its director? Third one is, what is the difference between loan and deposit?
Right.
Fourth one is, what all are not deposit?
Right.
So I think these are the four questions which has been answered on the definition.
I would just like to add
in the
on
meantime you answer these four questions. You have already answered two, and I'll look for other questions.
Sure. I mean, this last question is what all are not deposit. I think that we discussed at length already, but I would just like to add a bit on amounts received from directors or amounts received from members. Exemptions applicable to private company is amount received from members is exempted. Now, when we read this exemption, we need to understand that the exemption comes with a condition. What's the condition? The condition is that the person putting the money gives a declaration that he has not borrowed the money himself. He himself has not borrowed the money. In other words, the director or the shareholder in question cannot be using himself as a conduit. So, I am reading the particular exemption. This is under Roman 8 of the definition of deposit in regulation 21C. Regulation 21C of acceptance of deposit directions, defining what is the exemption applicable in case of director. I will just read it out and make an important point. So, that exemption says any amount received from a person who at the time of the deposit. So, first of all we need to see the position at the time of making the deposit. Was a director of the company or a relative of the director of the private company. The person was a director. So, directors' deposits are exempted in case of every company, and relatives of directors are exempted in case of private companies, director or a relative of director. Now, this comes with a condition: the director or the relative, while placing the deposit, gives a declaration in writing to the effect that the amount is not being given out of funds acquired by him by borrowing or accepting loans or deposits from others. Idea basically is the director or relative should not be acting as a conduit. For example, he collects money from 50 persons and puts the money into the company as a director. So, will this pooling of money from 50 different persons and putting it into the company, will it be exempted? Answer will be no. Also notably, the position of director must be relevant at the time of placing the deposit. Several people come back and ask, by if we take a deposit from a director or baad mein we remove the director, will this deposit be exempted? Well, technically yes, it's exempted. However, I would strongly suggest let's not get into this practice of inducting a person as a director for the purpose of taking a deposit and later on removing from directorship. This is not, I mean, to get a person on board as a director merely for the purpose of taking deposit is surely not at all advisable. Therefore, I would strongly detest and strongly advise you against such a practice. Right? This is about deposit from directors, and likewise I said deposit from members, which comes by way of MCA notification of 5th of June 2015. That exemption is also subject to similar condition that the member in question is putting a declaration to the effect that he has not borrowed the money.
There are four more questions on the definition itself.
Yeah.
Can a company issue non-redeemable debenture more than 5 years, for more than 5 years? Second one is whether OCD covered under the definition of deposit, optionally convertible debenture. Third one is money received from promoters or their relative, whether it will be termed as deposit. And fourth one is in regard to maintenance deposit taken from society in a public limited company is considered a deposit or not.
So, let us take up the last question. If let us say a company which is carrying out the maintenance for a building, it is basically what normally section 8 company which is carrying out maintenance of a building, it gets deposits from tenants, or let us say company which is let out flats or let out offices gets maintenance deposits from tenants. Will such a deposit be taken as deposit? Very clearly the answer is no. If the money placed is to secure a potential obligation of a counterparty, the deposit in real sense is basically it's nothing but a security deposit. There is no question of such a deposit being taken as deposits. Optionally convertible debentures. I had mentioned earlier that optionally convertible debentures used to be exempted earlier. Later, after the 2012 episode, I don't need to name the company once again. Well known case, always, almost always in the highlights in papers. Pursuant to that episode, the regulators removed the exemption for OCDs. So OCD by itself is not exempt. However, we can still go back to the other clause I had mentioned earlier. Any amount received by a company from a company, as long as you are receiving money from a company, it may still be exempted. However, if you are issuing debentures to a company and the company is downstreaming meaning next day the company sells off the debentures to, let's say, variety of investors. Once again, that's not the intent of the exemption. The amount must be amount received from a company. In other words, I would like to there put a condition that the debentures or OCDs are transferable only to companies. But I always do understand when it comes to deposits that we are not trying to exploit the exemptions to cover a situation which was not envisaged by regulations. Deposits are a very serious law, and I repeat what I mentioned when I started off, that any breach of deposit regulations, non-compoundable offence, several years in jail, few crores of fine. So please do bear in mind that even a in-spirit breach of the regulations may land a professional or the company or his client into a serious trouble. So I would not suggest exploiting any particular exemption. A lot of people I know recommend that we can issue debentures to a company and then tomorrow the company can start downstreaming or downselling the debentures to individuals or HNIs or partnerships and so on. Strongly, I would strongly advise you against such a exemption. That exemption, though, in spirit is very clear that we are using the company only as a conduit. So if the money is genuinely coming from a company, it would stay exempted. I think the same thing goes. Somebody also asked, what about non-convertible redeemable debentures? Non-convertible, redeemable, unsecured, secured debentures are anyway exempted. Secured debentures are exempted with the condition that the security is at least equal to the face value of the debentures. Recently, the MCA brought another exemption. The very important exemption is that even unsecured debentures, non-convertible, redeemable, unsecured debentures may also be exempted with the condition that the debentures are listed. So listed unsecured non-convertible debentures will also be exempted from deposit regulations. I'll be separately coming to debentures, talk about different types of debentures. So I'll just park this discussion as of now. But briefly, as I mentioned, yes, if it's a listed debenture, exempted.
One more question: if advance from customer is lying with the company for more than 365 days, how it will be shown in DPT3? I think this is form related query.
Correct.
But first part of the question can be
right.
answered, and second question has been asked. Again, you have already explained amount held in trust.
Right.
So kindly throw light again on the amount held in trust.
So let me first talk about this amount received. Okay, if you can move down, please. Let's first take up this amount received in trust, money held in trust, and then I come to advances for goods and services. As regards advances for goods and services, a lot of confusion prevails among professionals, so I just need to clarify that a bit further. Let me first talk about amount received in trust. I mentioned earlier what's the meaning of amount received in trust. I am simply a trustee. I can't use the money myself. There is no question of paying interest on the money because I have got the money as a trustee. The money will be deployed for a purpose for which the money is conveyed to me. Take an example, let's say 10 people join together, they hand over their money to me, saying, Bhaiya, ye paisa aap collect karo and you invest the money in buying a building. So I am basically doing what? I am buying a building which is jointly owned by 10%. Money came to me for investing in buying of a flat or a building. This is not a case of a deposit because I am simply a trustee. I couldn't have used the money to buy something else, for example, for buying a car, because the money came explicitly for buying a building. So I am simply a trustee. I don't have right to use the money except for the purpose for which the money was passed on to me. I am simply a trustee. The beneficiaries are the people who contributed the money. Now, wherever there is a question of money received in trust, please do bear in mind that there is a strong potential for the case being a case of an alternative investment fund or a collective investment scheme or a portfolio management scheme. So say if people are contributing money to me and they are saying that you kindly invest the money in buying shares of companies. my colleagues, my friends entrust their money to me saying, I am very good in equities, so I invest my money in buying shares of companies. This is exactly what is a portfolio management scheme. So I cannot receive the money unless I am a SEBI registered portfolio manager. I can carry it out and only under PMS scheme of SEBI, for which I need to be a registered portfolio manager. Take another example, the earlier example I gave. 20 people give me money saying, buy me a flat. 20 people are collectively buying a flat. Or for that matter, people are, let's say, pulling in money saying, buy me, let's say, buy me gold. 20 people jointly give me money that, hey, mera paisa, you buy it, use it for buying gold. Will this be a case of a deposit? It's surely not a case of deposit. But this may very easily come in definition of alternative investment fund. Definition of alternative investment fund coming from AIF regulations is wherever there is pooling of money to be used for buying a property or for carrying out an economic activity. This may easily be taken to be an AIF. If I am an AIF, once again, I need registration as an AIF. I cannot use money, I cannot pool money other than being registered as an AIF. If I am getting money from public to be, let's say, used for buying of a property, etc., then the chance is very strong that the money will be a CIS. So it's very important to understand the meaning of AIF, CIS. Collective investment scheme, the money is put by different investors, the money is pooled together and the money will be used for some common purpose. That's a collective investment scheme. And collective investment schemes also need to be registered with SEBI, and there are of course stringent conditions on rating, etc., that the scheme has to be rated by rating agency, otherwise such a collective investment scheme will be illegal. I must once again warrant here that SEBI also has extremely stringent penalties for somebody breaching CIS regulations. This is something which I am sure you would have noted that in the past there were several schemes where people pooled money. Long time back people pooled money for buying plantations. Sometimes people pooled money for buying some other assets. Recently people have pooled money for buying properties or land. Sometimes people pool money for timeshares. So all of this, if there is a pooling of money from passive investors and the money will be used for some common purpose, it may most likely be a CIS under SEBI, and that also attracts serious penalties. If I am pooling money for investing in stocks, if the money is getting pooled meaning commingled, it then becomes a mutual fund. If it is not commingled, it then becomes a portfolio management. So both of these require registration. So when we talk about money received in trust, we need to be carefully evaluating the potential for the transaction being taken as a mutual fund, PMS, AIF or CIS, and therefore be careful of that. I next move to the advances for supply of goods and services. This is also a very commonly misunderstood issue. So moved up, yes.
Before you explain this topic, I raised this questions received on this topic basically. A public limited company received deposit from supply of goods. However, the said deposit could not be adjusted against the sale proceed due to control beyond the control of the company. The said deposit was also received from the public company limited. Management opines that it can be considered as intercorporate deposit, which is exempt deposit. Is it correct, or whether company has made default and what are the consequences? So problem is that there are two exemptions available. One is relating to 365 days business advances and second is intercorporate loans. So when it has been received, it was an advance, and later on when it was not utilized, so management has thought that why not it will consider as intercorporate loans.
Sure. Okay, I understand. Okay. So let me first try explaining the concept of advances for goods and services and circumstances in which advances for goods and services become a deposit. This insertion of this clause is new, it was not there in the 56 Act. The clause was inserted in deposit rules of 2014 under the 2013 Act. Now what was the purpose of inserting this clause? I had mentioned earlier that extremely clever use of definition of deposit by people, particularly in West Bengal, where de facto deposits were being termed or structured as advances for purchase of goods. I gave an example earlier. I said a lot of money was collected from hundreds of people saying they are placing order for buying of sarees. I am sure you would have never seen people placing money in advance for buying a saree 1 year later. But nothing stops a person. I will place money now because I have money now. 1 year later, I have got a festival coming up, so I am placing money now for purchase of sarees. If actually sarees got delivered, there was no problem, because that is quite common. You receive money and 1 year later you sell supply sarees, no issue. But what happened in almost most of the cases, the contract for purchase of sarees was cancelled on the due date and the entity returned money with interest. Now what does this imply? That actually what was happening was a de facto deposit case. So there were lots of cases of booking of tours, booking of flats, booking of land, booking of sarees, booking of rice. People paid money for delivery of rice 1 year later. Surprising. So this is nothing but ingenious, I would say though culpable but ingenious use of definition of law to take a contract out of deposit definition by taking it to be advances for goods and services. So the MCA inserted this definition saying if you are receiving advances for goods and services, appropriation must happen in 365 days. Mind you, the word is appropriation, the word is not supply. A lot of people actually take it to mean that supply must happen in 365 days. But supply is something which is contractual, that is a commercial contract. I pay money for my cable TV connection in house, I pay money for next 3 years connection. The actual enjoyment of service is done over 3 years. Does that mean the cable TV company is actually collecting deposit from me? I pay for insurance premium for a term of 5 years. Are we meaning to say the insurance company is actually taking a deposit? I book a banquet hall in a hotel thinking it is going to be busy marriage season. I book a banquet hall to be used in December 2018. I am acting wise. I am placing money in advance for use of banquets in 2018. Is it a deposit? So please do understand, the intent of law is not to say that the actual supply of goods or services must happen in 65 days. Intent of law is appropriation. The money is allocated, ascertainable, the money is fixated from the very beginning towards a particular supply of goods and services. I am placing money not generically, not for buying any goods or services, but for buying a particular goods or particular services. That is what is appropriation. In other words, if generic money was put without knowing what am I going to buy, in that case the appropriation must happen within 365 days. If the money was placed for buying a particular machine, a particular service, a particular goods, a particular something, I would say then it was appropriated from the very beginning, and therefore we are not referring to the actual timing of supply of goods and services, we are talking merely about appropriation. The question put a question that we received the money for supply of goods. Supply of goods did not happen. So if this is an exceptional one-off case, I would very clearly say that we are not trying to defeat the law by taking the so-called advances as so-called actually de facto deposit, but calling it merely an advances against goods and services. However, I take money from hundreds of people calling it advances for supply of goods, and then say supply of goods did not happen for reasons beyond my control. Circumstances indicate that this is actually nothing but a de facto deposit. I am simply giving it a nomenclature of supply of goods and services. In that case, even if I return the money within 365 days, so 365 days is not the magic word here. The magic word is, are we getting money for supply of goods and services which are ascertainable, specific contract of supply of goods and services, or are we generically getting working capital funding? If you are getting working capital funding in the guise of a contract for supply of goods and services, we are actually breaching the law, attracting the penal consequences. For me, therefore, if there was a genuine commercial contract meant to be completed by supplying goods and services, if I fail to do them in 365 days, and the failure is not like routine, the failure is like exceptional, in that case, even if the entity in question was a company or not a company, would not make a difference. If the entity was a company, for sure you could probably say it was an amount received from a company and therefore it is anyway exempted. But I would reiterate to say that this particular clause talking about advances for supply of goods and services is referring to generalized receipt of money, not against an ascertainable or specific contract for goods and services, and in that case the appropriation must happen within 365 days.
Two more question on this particular point itself, or maybe related point. As advance received under long term projects for supply of capital goods except those covered under item B above, rule 2 1C 12D. What is capital goods here and from whom it should be should be received? Second one is, if a company is accepting deposit in the form of monthly installment at its various offices located in different cities of India, and also the receipts are issued from there as well as redemption is also done from there, then whether the register of deposit is required to be maintained. I think this is regard to register and records, but the main question is that if we are receiving money in say installments, like one question is also there that this hotel and hospitality companies are receiving money say for 3 lakhs rupees advance, and you enjoy hotel stay for say next 5 years or 10 years. So that membership which they are offering offered by the hospitality companies, whether that amount will be termed as deposit or not.
If somebody is receiving money for a supply of goods, I mean the money will never be returned, the money will be used only for adjustment against goods or services. Like take the example of the first, let me just go to the capital goods case. I had explained my viewpoint and I had mentioned that irrespective of whether it's capital goods or consumer goods, what we need to understand basically is whether the money was received for a specific contract, ascertainable contract. If yes, then from the very inception it was appropriated against a particular contract, and we don't need to go beyond that. If I talk about the exemption for capital goods obviously don't mean capital goods for the supplier. I mean for the supplier it's not capital goods for sure. Capital goods would mean capital goods for the buyer. Mostly it would mean those goods which take a long time to complete. So I am receiving money for supply of capital goods, which might probably mean, let's say it's a construction contract, it's a contract for fabrication, it's a kind of contract which requires a long time to complete. In those cases, if the money is received against a particular contract, the contract may span beyond 1 year. Merely because we passed out 1 year would not make it a case of deposit. The other question, we talk about maintenance of a form or maintenance of register of deposits. Please don't send the question of form or filing or register would arise only where the money in question is a deposit. If the money is in question is a deposit, first of all we are not even receiving this as in compliance with law. We are incurring a serious breach of law, because deposits can be accepted only with a substantial discipline. There is a limit on acceptance, there is a rate of interest, there is a advertisement required, there are a whole lot of requirements for accepting deposit. Your company actually may not even qualify in terms of the conditions mentioned in law for accepting deposits from public. So the very acceptability will be in serious question, not to mention the filing of forms or maintenance of registers. I mean whether you can do is a larger question, and therefore you can do of course, but with the specter of spending several years in jail and paying a few crores of money as fine. Maintenance of contracts or maintenance of registers will not help you there. So the more important question is the receivability itself. The installment schemes, I mentioned earlier that if you are collecting money in installment, whether you do at head office or at branches or at retail locations, if you are receiving money in installments and there is a benefit being passed on to the installment payer, which is very obvious. Why would somebody pay money in installments unless I get a benefit? Now on the day on which the contract was initiated, that is on the day on which I started paying the installments, if I have a specific contract for supply of specific goods, I took an example of jewelry earlier. I said I know what bangles am I going to buy. I start paying money for a specific design, a specific set of bangles, which I will take delivery of 1 year later. There is nothing that stops me from placing an order today for bangles to be delivered 12 months later. And sure enough, since I am paying the money today, the shop will charge me less than what the price would be 12 months later, because the entity in question is getting a benefit. So if I am prepaying for specific goods, every case of prepayment is not a case of deposit.
What is however a deposit is, I don't know what I am going to buy. I will buy jewelry, I will buy it from a particular store, but I don't know whether I will buy bangles or I will buy a necklace or I will buy whatever else, and I am paying money month on month, which is only defined in terms of value, not defined in terms of bangles, it is defined in terms of value. So I will place 1000 per month every month, I have paid therefore total 11,000. 12th month I will be able to buy jewelry worth 12,000, which is 1000 is the additional benefit I get. This to my mind is nothing but a deposit, because you are actually doing what? You are getting a monetary benefit for placing money. I mentioned that, therefore I repeat my definition with which I started. If you by heart this definition, take it to your heart, not merely to mind but to your heart, then I don't think we will falter on understanding what is a deposit. I said a money for money transaction. You are placing money to get back money. You are placing money to get bangles, not a case of deposit. You are placing money to get money back or value in form of money, that is a deposit.
Mr. Kothari, you mean to say that even if it is for 365 days, but if it is defeating the intent and purpose, and if it is given the color of say deposit and say getting the interest back,
Absolutely.
or benefit back, then it will be a deposit.
Absolutely.
Because similar question has been asked, sale of jewelry for 11 months, kitty of by a private limited company, engage of selling of jewelry. So what about after 12 months? So I think even in case of 11 months, it will be treated as deposit.
Absolutely.
Forget about 12 months.
Even 10 months for
10 months it will be treated as deposit.
You are getting money in installments. 10 months later you give him value. You are not giving a particular piece of jewelry, you give him value.
So
money you can switch from bangles to necklace or necklace back to bangles, or take money out. That would mean the intent is very clear, is to receive working capital funding. Working capital funding by the vendor, that is what is a deposit.
This will
Pre-advances for supply of jewelry, or for that matter any other goods. So 365 days not is the magic word. Magic word is basically what is the intent of transaction. Is it a financial contract where you are receiving money to be given back either as money or monetary benefit? That is a deposit.
So if a particular thing is definitive for the purpose of 11 months, say goods has already been defined or services has been identified, then definitely it will be passing through the criteria of 365 days, otherwise it will not. I think it has clarified a very important and critical point, because I have received at least 10 questions on this particular point. So move on forward, sir.
Right. So we talked about these two very significant exemptions, and I would now come to, I will very quickly pass through provisions of law. I said mostly companies actually do not intend to get into deposit taking. I mean, they are wanting to definitely get some working capital support, but technically getting into deposit taking using the provisions of law, that is mostly not in the minds of lot of companies. So section 73 talks about companies getting deposits from members, and section 76 talks about getting money from other than members, which is the real public deposit. Section 76, which talks about the actual public deposits, is in case of public companies, meaning eligible companies whose net worth is at least rupees 100 crores, turnover is at least rupees 500 crores, or has passed a special resolution in general meeting for accepting deposits. These entities may accept public deposits, but the prerequisite there is a credit rating, there is a creation of security interest, there is a deposit insurance also required, and in any case if you go through deposit rules, the maximum amount up to which companies can raise deposits is only up to 25% of the company's net worth. So, and when I began, I started saying that, is it at all making sense for companies to get in deposit taking? If a company has the intent of repaying deposits, then it does not make sense to get in deposit taking. So only those companies which do not intend to actually get, refund back the money, and those companies may find deposit taking viable. But if the intentions are good and you intend to actually give back money, then the real public deposit schemes have lost their relevance, because it is much easier to now get loans from banks, or to issue debentures to capital market institutions than to get into deposit taking. If you evaluate deposit taking, please do not be limited to the interest that you pay, please also take into consideration the servicing cost. Deposit is a public source, public retail source. It has substantial servicing cost. You need to maintain branches, you need to maintain brokers, you need to maintain staff to service depositors. So the all-in cost of a deposit turns out to be extremely high as compared to bank finance. So there is, according to me, no relevance in real life public deposit schemes. And of course, therefore, we mentioned earlier that this was the trend in 1970s, 1980s. In 1980s particularly, there were lots of defaults of deposits, and therefore the whole scheme became highly unviable over time. For companies which actually were holding deposits as on date of commencement of law, section 74 required the company which has accepted deposits to repay by 31st of March, and that is where the form DPT4 etc. came. MCA came with a clarification to say that something which was as on date of acceptance, not a deposit, for example deposit taken from shareholders in case of private company, was excluded from purview of deposit. In that case the requirement of DPT4 etc. would not be applicable for such companies. I would very quickly zoom past deposit rules, because deposit rules will apply if the company is actually taking deposit. Yes. And otherwise, the question of acceptability itself is not relevant, but I will quickly pass through that and then straight go to debentures. So deposit rules, we first talk about the tenure. Deposits have to be at least for 6 months, maximum for 36 months. On demand deposits cannot be accepted by companies. Companies cannot take short term deposits of less than 6 month maturity. So it has got to be 6 to 36 month maturity. And short term deposits are possible though, but that is a limit of 10%, which is once again very small to be of any relevance. Next rule talks about limit on acceptance of deposits, which is 25% of the net worth of the company. There is a restriction on rate of interest, which is notified by the Reserve Bank of India, and there is also a restriction on the rate of brokerage to be paid. So these are relevant if the company is actually getting into deposit taking. If we move forward, we also say that for companies accepting deposits from members and companies accepting deposits from public, they will also need to provide for deposit insurance. They need to go for deposit insurance as well. The cost of insurance of course is on the company. And the next rule, rule 6 says that if company accepting deposits from members or accepting deposits from public will also have to create a security for at least an amount remaining unsecured by the deposit insurance provided. That is to the extent of, for example, let us say we take deposit insurance but up to a particular amount, then for the remaining amount we have to create a charge in favor of deposit holders. So deposit actually becomes therefore a secured mode of funding, and this also by itself becomes prohibitive because the assets of the company normally are already charged in favor of lenders. Lenders may not even see the pari passu charge. So question of securing debentures may not mostly be practical. I will quickly move forward and talk about the next thing, which is since you are creating a charge, you need to have deposit trustees. The trustees are the people in whose favor the charge is created, and of course the company also needs to create a deposit repayment reserve. 15% of the money falling due for repayment by during the financial year needs to be actually funded and put into a deposit repayment reserve. This becomes a kind of funded repayment reserve so the company cannot use this money other than for repayment to deposit holders. I would move straight forward and come now to, I will skip other detailed rules about deposits, and I think I will very quickly first give a very quick, move down, that is fine, very quick review of deposits in case of non-banking finance companies. If the company is in fact a non-banking finance company registered as such with the RBI, then the deposit rules applicable to NBFCs are not companies deposit rules 2014. What is applicable to them is master directions of RBI on acceptance of deposits. So for NBFCs we need to refer to the RBI's master directions. Significant differences between RBI directions and the MCA deposit rules. Significant difference would be that in case of private companies, in case of non-banking, non-financial company, the exemption for deposits from members is up to a limit of 100% of paid up capital and free reserves. In case of non-banking finance companies, amount received from shareholders is completely exempt. There is a total exemption irrespective of limit, in case of NBFCs by way of amount received from shareholders.
There are 3 questions on this particular point. Can you pause a bit?
Sure.
What are the filing requirement to be done if the loan is accepted from the shareholder or relative director? Notification state that necessary filing need to be done, but no forms or nothing has been prescribed. Second one is private company access deposit from its member less than 100% of net worth, whether DPT3 will be required to be filed or not. And third one is that can say similar question, that form has not been prescribed, so how to intimate ROC in regard to exemption, availing the exemption.
Okay, so let's first take up this part. The exemption given to a private company for deposits from members, 100% of net worth. Now, this is something which came by way of the notification of 5th of June.
Yes.
And the notification, yes, you are right in saying the notification did say that the company shall file appropriate return with the registrar. There is no return so
No
far
return
laid down.
so far has been prescribed.
So there is no return, that would mean there is no rule for filing of a return, and therefore the question of any filing as such, all that we need to ensure is that we are getting deposit from a member. The member is giving a declaration that the amount is from his, the amount is not borrowed from out of borrowings done by him. Subject to that, it would stay exempted. Filing requirement as of now is not laid down. But laid down, which
if,
means it's not effective.
if filing requirement has not been laid down, form has not been prescribed, but general form is already there, which talks about that anything you want to submit to ROC, you can file through the general form. So I think GNL 1 form or 2 form, what I think 2 GNL 2, which is general form, which we can file always. If no form, such form
I
has
agree.
been-
I mean, you can basically what you will find that we have collected. I mean, this return
Yes,
will basically
yes.
be listing out that we have collected money from the members. You can actually file it with a GNL 2 as Pandit mentioned. So we can actually do that. Next question was whether I'll have to, if I'm collecting money within 100%, will I have to file it as return of deposits? So when we say that it's excluded from purview of deposits, we're actually saying it's not a deposit at all. If it's not a deposit at all, the question of compliance with deposit rules would not arise at all. This is a case of exemption, that would mean up to 100%, it's not a case of deposit at all. Hence, in my view, there will be no case for filing of any return of deposits or DPT3 or the appropriate return. Right, I'll move forward straight away and come to debentures, which is a very connected topic, and of course I've got a pile of questions already there, so we'll probably come to the questions also, but I'll straight move to debentures now and then we take up the questions. When we talk of debentures, we need to understand several types of debentures, and the regulatory aspects of each of these types are different. So from point of view of transferability, we can think of transferable or non-transferable debentures, freely transferable versus non-transferable, or when from point of view of tenure, we can talk of short tenure versus long tenure. What do we mean by short tenure? Tenure of up to 12 months. That's why do we at all talk about up to 12 months tenure? Debentures up to 12 months tenure are covered by RBI guidelines on short term debentures. So these are short term debentures, they are up to 12 months maturity. Long term would be therefore anything above 12 months. From point of view of convertibility, we can talk about convertible versus non-convertible debentures. Convertible once again could be compulsorily convertible, optionally convertible, or contingently convertible. When I say contingently convertible, they are convertible though, but convertible only when a certain contingency happens. Contingency, for example, could be in the nature, for example, could be, let's say, the performance of the company. If the company's performance is, let's say, above a particular level, then the debenture holder has a right of conversion. If the company's performance is not up to a particular level, the debenture holder has a right of enforcing his redemption right or cash out his money. Non-convertible debentures, of course, could be redeemable or could be perpetual. Perpetual debentures are relevant, as I mentioned I think during my initial part also, they are relevant for non-banking finance companies and for banks, because this is called perpetual debt instrument, PDIs. PDIs count as a part of tier 2 capital for NBFCs and banks, so this is relevant only in case of banks and NBFCs. As for non-banking, non-financial company, a debenture has to be redeemable within a particular maturity, and therefore the question of perpetual debenture in case of non-banking, non-financial companies would not arise at all. From point of security, debenture could be secured or unsecured, and from point of your public participation, a debenture could be publicly offered or maybe privately placed. Publicly offered debentures have to be listed. Privately placed debentures may be listed or may be unlisted. This is a very important point to understand, that even privately placed debentures may be taken for listing. Listing regulations for debt securities permit a debenture to be listed even though the debenture was not offered to public. So, offered privately, issued privately, however, after issuance we go for listing. So, listing is allowed even if the debenture is privately placed. Regulatory aspects of each of these, the potential for each of these instruments being covered or not being covered by deposit rules will be different. So, let us first straight talk about secured versus unsecured. Secured debentures, are they deposits? Secured debentures, secured debentures are the deposits. We had earlier discussed that secured debentures are excluded from the purview of definition of deposits. Condition being, the amount of the value of security is at least equal to the par value of debentures. So, that would mean fully secured debentures secured by charge on the assets of the company are exempt from deposit definition. Technically sounds possible for a company to secure debentures by assets. Practically, however, for most non-banking, non-financial companies, thinking of securing debentures is like getting approval from existing lenders, existing bankers who already hold a charge on the company's assets, they agreeing to cede a pari passu charge in favor of debenture trustees mostly would be impractical, because the value of assets may not have that kind of so called over collateralization value, over collateral or extra free collateral. So, bankers may not even agree to cede a pari passu charge in favor of debenture holders. Hence, the thought of creating security interests may largely remain theoretical, practically may not be possible at all. Unsecured debentures, are unsecured debentures at all allowed? Now, over the years what we have kind of understood is that unsecured debentures are treated as deposits. So, unsecured debentures are not allowed because they are taken as deposits. I had mentioned that the amendment in deposit rules done by MCA last year, a very important amendment was done to say that unsecured debentures will also be exempted from deposit rules provided the debentures are listed. So, listing once again could be in two scenarios. We offer debentures to public or we offer debentures privately, but then we go for listing. So, both scenarios. Unsecured debentures offered to public, will they be taken as public deposits? Answer will be no, because mandatorily anything which is offered to public has to be listed. So, this will be coming under the listed debentures exemption window, and therefore, publicly offered unsecured debentures which anyway are listed will be exempt from deposit rules. Next, unsecured privately placed debentures later on taken for listing. So, basically when you issue the debentures, the term sheet or the information, the offer document will say that we intend to apply for listings, and we do actually apply for listing. Mostly before offer we would have taken a in principle approval from the stock exchange that whenever issued the debentures will count for will be eligible for listing. So, we issue debentures privately, unsecured debentures. These debentures are issued privately and later on they are taken for listing. Will they be exempted from deposit rules? Once again answer will be yes. Question will be, how many debenture holders can I have in that case? If I am offering debentures privately, to how many debenture holders can I actually offer the debentures? So, I am sure you will be able to relate that I am now referring to section 42. Section 42, this is a private placement of securities. Section 42 would say that in a financial year I cannot have more than 200 subscribers to securities that I offer. So, assuming that this is the only issue of debentures I have done, the maximum number of debenture holders will be limited to 199. The moment I reach 200, it will become a deemed public offer, and therefore the public offer implications of Companies Act would come in. So I can offer debentures privately to up to 199 persons. They may be unsecured debentures. They will still be exempted if I am taking the debentures for listing. A notion was prevailing some time back that unsecured debentures cannot be listed at all, because somewhere the listing rules, which is called ILDS, issue and listing of debt securities rules, somewhere talk about security cover. Now this is something that we have discussed at length and very often spoken to regulators also, and the confirmation that we got is that the question of security cover etc. would be relevant only where the debentures are secured. You cannot seek security cover in case of unsecured debentures. So unsecured debentures would still be exempted without reference to the security cover condition in the ILDS regulations. I next come to optionally convertible, compulsorily convertible and contingently convertible debentures. Compulsorily convertible debentures, what CCDs, what is their nature? CCDs are in the nature of deferred equity. Deferred equity actually means what? The person is subscribing to a debenture, it remains a debenture until converted, and it automatically and compulsorily converts into equity within a maximum time frame. The money will never be refunded back to the CCD owner. There is no question of option here for the CCD holder to withdraw his money out. Now there are some very interesting questions that arise here. Supposing the company is issued CCD and say the CCD is convertible into equity within 5 years. During this tenure of 5 years, by the way, before I come to this question, let me just answer some small issues here. Can a CCD carry interest until converted? Can a CCD have interest? Of course it can have. There is good reason for a CCD not to carry interest at all, because actually the CCD holder is getting a future equity instrument. He is being compensated by the rate of appreciation on equity, and therefore he may not carry interest. It is perfectly okay if the CCD does not have interest, but if the CCD has interest, there is nothing wrong in the CCD having interest. Can CCD be secured? Now this is actually counterintuitive. If CCD is actually a compulsorily convertible instrument, question of security comes for securing an obligation. In case of a CCD, the company will never have an obligation to repay the money, and therefore the question of CCD being secured would, though I think people can actually structure a secured CCD, but I think it is completely counterintuitive and I do not think it is completely at all necessary. Question I was going to talk about was a little complicated question, interesting question. Before conversion, 5 years, let us say the conversion, before conversion the company goes bust, the company gets into insolvency, the company becomes insolvent. Will the CCD command status of a debt or will it command status of equity? I am sure all of you would understand that when it comes to distribution of assets in liquidation, equity is the last recipient, last item in the waterfall. Lenders or debenture holders will be like number 4 or number 5, in most cases number 4 in the waterfall. Equity will be number 7, number 8 in the waterfall. So will a CCD holder qualify as a secured creditor or unsecured creditor, financial creditor, or will he qualify as equity holder? There are court rulings to suggest that the nature of a CCD before conversion is that of debt, and therefore if before conversion the company goes into liquidation, the CCD holder will be able to qualify as a financial creditor, which means number 4 in the priority list. Now that brings another very interesting question. Can a CCD holder himself file for insolvency of the company? Supposing the CCD was carrying interest and the interest is not paid, can the CCD holder himself go and file for liquidation of the insolvency of the company? While legally my answer would be yes, but to my mind the terms of issue of a CCD must provide that the CCD holder himself shall not file for insolvency, because this once again becomes counterintuitive. because you trigger the insolvency, and once the company goes into insolvency, you become, you rank at par with unsecured lenders instead of being equity owner. So, this is basically a question of devising the terms of issue. CCD therefore is an interesting instrument. CCDs are exempt from purview of deposit rules. OCDs, we discussed several times during our talk, OCDs used to be exempt pre 2012, after that the exemption was withdrawn. However, OCDs issued to companies and transferable to companies only may avail of the exemption applicable to an amount received from a company. Perpetual debentures or subordinated debentures, these are instruments offered by NBFCs only, and therefore that is relevant for financial entities. So, CCDs I have discussed already, and I think we have discussed at length. I will therefore move forward. OCDs we just discussed. OCD is a very interesting financial instrument. It allows a company to reduce cost of debt by adding an equity element. The debenture holder gets a potential right to capital appreciation because he has got a right of conversion. At the same time, it is principal protected because the OCD holder may decide not to convert, but to seek redemption. So, it is a very interesting financial instrument, nothing wrong in it, nothing I would say to be seen with disfavor, nothing to be seen skeptically. The only thing is that OCDs can be issued only to companies, otherwise they will be captured in the definition of deposits. This is a very crowded slide, as you could see, but we have discussed most of this, because most of this we have discussed the regulatory sides applicable to it as we talked about. So, I will move forward. We also need to understand when we talk about debentures, there will be several other regulations applicable to debentures. Issuer debentures is not merely deposit rules. When it issue debentures, we are covered by section 77 of section 73 of the section 71 of the Companies Act. Section 71 dealing with debentures, we need to comply with section 71. We need to ensure that it is not a deposit in terms of section 73. We need to, if we are going for listing, we need to take into consideration the ILDS regulations. We will obviously have to appoint a debenture trustee. So, debenture trustee has to take care of the trustee regulations also applicable. If you are going for short term debentures of up to 12 months maturity, we need to take into consideration the RBI's non-convertible debentures, short term debentures directions of 2010 also. And of course, if you are issuing debentures to, if you are going for listing, we also have to be concerned with SEBI LODR regulations, because for a debt listed company also LODR regulations are applicable. So, the other thing about debentures which is very important is DRR. So, if we straight come to debenture redemption reserve, next, I think surely DRR. I will just very quickly talk about DRR. I think I can very summarily state the situation. DRR is applicable in case of issue of debentures by non-banking, non-financial companies. Non-banking, non-financial companies which issue debentures, they will require to create a DRR. Non-banking financial companies, for them DRR is not applicable. DRR is therefore not applicable to NBFCs other than in case of a public offer. And if you are creating a DRR, then the next thing is also to create a debenture redemption fund, DRF. The requirement of DRF says that if you are covered by DRR requirement, then in case of debentures maturing within the financial year, by 30th of April, you need to place 15% of the amount into permitted securities, which is primarily bank deposits or liquid government securities. So, this is of course applicable only if the company is going for only if the company is covered by DRR requirement, and as I mentioned, DRR requirement in case of non-banking, non-financial companies is applicable to the extent of 25% of the money raised. DRR requirement is not applicable to non-banking, non-financial companies. I think at this stage I will pause to see questions that have come so far, and then I think we will probably go further based on how much time do we have at disposal.
There are a lot of questions on debenture, so I will quickly, I think we will just answer in yes or no, because the time is very less. So definitely I will ask question on debentures and there are 20 odd questions on debenture. So let us start. Is it mandatory to appoint debenture trustee for issue of debenture in a private limited company?
A private limited company can never go for a public offer. A private company is prohibited from offering debentures to public, which would mean private company is required to offer debentures to, privately only. It
Private
cannot make a
company's
public offer.
debenture, huh.
And appointment of debenture trustees is required in case of a public offer. So strictly the answer would be no, because there is no question of public offer, and there is no question of DTs, debenture trustees, unless it is a public offer.
Whether this trust deed is required to be registered?
Trust deed is actually, so normally a trust deed, it's a practice in different places. Trust deed is a deed between the settlor and the trustee, and the trust deed may or may not be registered. If the trust deed is dealing with immovable property, it then is required to be registered. So if you are creating a security in, at least partly many companies actually do, is to create a security in land also. You will mostly find in case of secured debentures, companies go and create a security on land. They probably buy a small piece of land in Kutch, very cheap land, and they create security on that land, or they create multiple securities on a small piece of land in favor of several debentures. Why are companies doing that? Companies are doing it primarily to avail of a Ministry of Finance notification which exempts stamp duty if there is a stamp duty paid on the mortgage deed. If there was a mortgage and the mortgage is duly stamped, then the stamp duty on debentures is exempted. People try to take that exemption, and therefore they go for securing debentures with land. So if the trust deed is for creating a charge on immovable property, which mostly that is the case, then the trust deed requires registration. If it's only charge on movable properties, it does not require registration.
There are 3 questions on one point: whether debenture trustee required to be appointed in case of secured debenture, as the act says in case of number of debenture holders are more than 500, then the company is required to appoint debenture trustee. And similar question is there that is appointing debenture trustee compulsory for secured debenture, more so when there is only one debenture holder, and that is AIF is subscribing the debenture to the company.
Okay. So why is the concept of debenture trustees at all arose? Debenture trustee is somebody who holds security interest on property in favor of or for the benefit of the debenture holders. If you did not have a debenture trustee, you will actually be creating security interest in favor of debenture holders. Debentures are transferable. So let's say if I borrow money from, or let's say I issue debentures to Mr. Ranjit Pandey and I create security interest in his favor, the moment Mr. Pandey transfers debentures, that will lead to amendment or modification of the charge, and therefore there will be a logistically impossible situation where debentures are issued to, let's say, 100 debenture holders. I create charge in favor of 100 debenture holders. All those 100 charges are required to be registered, and the moment those transfers happen, I need to be kind of modifying and registering every modification every time. So to avoid this logistic impossibility, the concept of trustee was brought in. We create a charge in favor of trustee, the trustee continues to hold the charge, debentures remain nebulous and transferable. So the device of trustee was primarily brought in as a logistic convenience for secured debentures. So if the question is, are trustees required in case of secured debentures, I would say logistically yes. Even if not required by law, logistics of charge creation and transferability will almost mandate, not mandate of statute but mandate of practicality, that will need to have trustees in whose favor the charge remains. Debentures will stay transferable. One question was, even if I am issuing debentures to a single debenture holder, but after all the debenture is transferable. So if the debenture holder in question tomorrow decides to transfer debentures, how would the security interest get transferred? Then I will need to enter into a fresh mortgage in favor of that transferee. Yes. So I would strongly recommend, in case of all secured debentures, we need to have a trustee. That's true in case of pledges also. Even if you have a pledge securing the debentures, even there it would make much much more logistic convenience to have a trustee in whose favor the charge remains and the debentures remain transferable.
Can I convert unsecured debenture into secured debenture?
I don't see any reason why not. I mean, all we need to do is to do a charge. So there's no bar on, I mean, converting secured into unsecured, sorry, other way around. Unsecured into secured, there's no issue at all. If I'm moving vice versa, I had secured debentures, I want to make them unsecured. I think other way the question will be more interesting. Can I convert secured debentures into unsecured debentures? There also the answer would be yes, provided I take sanction of debenture holders, because this is a question of variation of terms. So 75% of debenture holders have to agree. In that case, yes.
Next is there any capping of 5% premium on redemption of debenture under SEBI guidelines, or which provisions govern premium on redemption of debenture?
To my mind, there is no cap on redemption premium at all. In fact, you would find zero coupon debentures also. Zero coupon debenture, what's the concept? There is no coupon at all. The debentures are issued at discount on maturity value, and there is no coupon at all, and the entire return to debenture holders comes by way of premium, redemption premium. So question of a limit on redemption premium would never arise, because even zero coupon bonds are allowed. However, if you're talking about zero coupon bonds or low coupon but high premium bonds, you need to take into consideration the provisions of Income Tax Act. Income Tax Act, primarily ICDS, Income Computation and Disclosure Standard, on revenue recognition. ICDS on revenue recognition says that if you have a premium or discount in case of a debt security, the premium or discount will have to be amortized over time. That would mean the debenture holder will need to accrue income, the debenture issuer will need to accrue an expense, even though the premium or discount is coming at the time of maturity. So from point of view of income recognition or expense recognition, by way of ICDS, there is no difference between a zero coupon debenture or a low coupon debenture and a coupon bearing debenture. But as such, to answer the question once again, I can't think of any limit on premium redemption by SEBI or by any other regulator.
Can the intercorporate loan already extended to the company be converted into CCD, NCD or OCD? If yes, what would be the best option amongst them? I think second part of the question is not that relevant. Is there any restriction on coupon rate on such conversion?
Okay. So question was, can I convert an existing loan into a debenture subscription? This, I think, rephrasing question. Can I, existing money is lying. It may be lying by with a loan. It may be lying with, and it may be lying with the company in whatever form. My money is with the company already. Can I convert my existing money into a subscription for securities? Primarily, this question will be answered with reference to section 42, because 42 has whole lot of procedure on private placement. 42 also goes to say that you must get the money into a separate bank account, you must not use the money until allotment is done, etc., etc. So issue is, does section 42 at all permit a company to use pre-existing money and convert the same into a subscription for a security? My answer would be surely yes. Some people actually recommend the money must go out, then you get the money back into a bank account, etc. I don't think that's at all relevant, because that's artificial, not relevant. And the so-called debenture holder may say that he applies for my debentures and he authorizes me to use his money lying with me as his subscription. So the person would then sign an application form saying, my money lying with you, either as ICD or for whatever other purpose, may be treated as his application for debentures, based on which I can use the same money instead of refunding the money and getting back. So I don't see any bar on using existing amounts for issuing debentures. The restriction of coupon rate, please do bear in mind section 186 by 7. 186 by 7 says that if you given a loan, the loan must not carry interest lower than the prevailing yield on government securities.
186.
That section is applicable to loans, that section is not applicable to debentures. So if there was a pre-existing loan, the loan must carry a coupon rate at least equal to the yield on government securities.
Can debenture be secured by an asset of a holding company? Rule 2C9 of deposit rules exclude debenture secured by asset referred to in Schedule 3 of the Act, does it include asset of the holding company also?
So this question basically is, can third party securities be issued?
Yes.
So I am reading out from the rule. An amount raised by issue of bonds or debentures secured by first charge or a charge ranking pari passu with first charge on any assets referred to in Schedule 3 of that, excluding intangible assets of the company, or bonds or debentures compulsorily convertible into shares within a tenure of earlier originally 5, now 10 years. Provided that such bonds or debentures are secured by charge on any assets referred to in Schedule 3, excluding intangible assets, the amount of such bonds or debentures shall not exceed the market value of such assets as assessed by a register valuer. Reference to Schedule 3. If you track a history of the way this deposit rules have evolved, very interesting history. Originally the charge had to be only on immovable property. The original language was charge on mortgage of immovable property. That was the original language. I am talking about what existed in 1956 Act, and I think I am talking about situation that probably prevailed in 2009 or before that. It was only confined to security being on immovable property by way of mortgage. Later the law was made liberal and said any of the fixed assets of the company. Now that also led to a difficulty because fixed assets did not mean receivables or a working capital. Then the law was amended to say any of the assets of the company as appearing in the company's balance sheet. So what the lawmaker is trying to say is the assets, the debentures may be secured on any of the assets referred to in Schedule 3. That would mean whether it's fixed asset or movable property does not matter. Since the law is not necessarily expecting the assets of the company securing the charge, to my mind there is no bar on third party securities also. Subsea issues debentures, holding company creates a charge. To my mind that is not at all barred by regulation. Roman 9 because it is not Roman 10 because it is not specifically talking about assets of the company. It is making a reference to Schedule 3, which is merely to say that any of the assets, whether fixed charge, whether immovable property, fixed assets, floating assets or floating charge does not matter, it must be on the assets of the company.
Can two questions are there relating to OPC also. Can OPC receive deposit? This is the question, because private company receives deposit.
Okay.
OPC is also a private limited
OPC
company.
by definition is a private company. OPC
yeah.
has to be private company.
Yes.
A private company is barred from taking deposits other than from members.
Yes.
It
And
can of course take deposits from members.
Taking this question forward, can OPC issue debenture in case of scheme of merger, wherein the private limited company is getting merged into an OPC? I think this is
I'm sure I must appreciate the query's interest in OPCs. To my mind, OPC was largely uninteresting issue. But however, can an OPC issue debentures? If OPC is issuing debentures, if the OPC is issuing secure debentures, or OPC is issuing, let's say, listed debentures, I think listed debentures in case of OPC will be out of question, because OPC being a private company, it cannot invite public to subscribe to debentures. It can only offer debentures privately. So privately placed debentures. So if it privately places debentures and later on gets the debentures listed. It's I think possible. Secure debentures possible. So yes, technically an OPC can also issue debentures. It can issue secured debentures or unsecured but listed debentures.
Another question, can a private, is there any provision for face value of NCD issued by a listed company to rupees 100 per debenture or so?
That comes from market, the stock exchange. In order to ensure uniformity of face values, stock exchanges quite often require a uniform face value. So, from point of view of their tradability, uniform face value helps. So, you need to kind of, depending on which exchange you are going to, you also need to check with the stock exchange as to what are their listing requirement for face values. I think these days, to best of my recollection, face value is about 1 lakh or above, but please do check with the exchange as to what are their stipulation about face value. This is not regulated by ILDS regulations or Companies Act.
Can a producer company issue unsecured debenture to its members?
I'll have to park this question. Sorry, I'm not comfortable with the concept of producer company, so I'll have to park this question.
Okay. Will a debenture secured by an asset of holding company be treated as deposit?
This we just discussed.
We have
mentioned,
asked,
we
can
just discussed,
0% debenture be issued?
which also we discussed in course of a discussion, that zero coupon debentures, there is nothing wrong and they are perfectly okay. I mentioned the ICDS on revenue recognition on zero coupon debentures, that the discount or premium, discount on issue or premium on redemption will have to be amortized over time, both by the issuer and by the investor. Technically there is nothing wrong in zero coupon debentures.
In case of convertible debenture, do we require to increase authorized share capital at first place or at the time of conversion?
Interesting question. The question is, when the company issues convertible debentures, the company does not know. Convertible debentures are optionally convertible, compulsorily convertible. Supposing debentures are compulsorily convertible. So, we I think break the question in two parts. The company is issuing optionally convertible debentures, compulsorily convertible debentures. Compulsorily convertible debentures, the authorized capital of the company does not permit the debentures to get converted, because existing bandwidth or existing space in authorized capital is not enough for the debentures to be compulsorily convertible. Now that would mean, does the company have to change authorized capital now, or can the company change authorized capital at the relevant point of time whenever the conversion happens? Technically it is perfectly possible for the company to issue CCDs and change the authorized capital when it comes to conversion. In case of CCDs, conversion is not optional, conversion will necessarily happen. So whenever conversion happens, the company may at that stage pass resolution for increasing authorized capital. Counter argument however to that would be that since passing of resolution for change of authorized capital is still in the control of members, members may defeat the convertibility by not passing resolution for increase of authorized capital. So technically I would say it's though possible to wait for the capital to be increased later, but you need to see whether the company is so closely controlled that the possibility of shareholders turning down the resolution is a mere hypothetical possibility. If the possibility really exists, the shareholders may not approve the authorized capital change later, then I would technically not call the CCDs as CCDs, because then we are still leaning on potential support of the equity holders for change of authorized capital. Sorry, just to extend the question, had it been optionally convertible, in that case for sure the option is with the debenture holders. So there is no reason for the company to increase capital at the first instance, because the debenture holders in question have not even opted for conversion. So you cannot for sure know whether the debentures will get converted or whether they will actually be redeemed.
Money falling under the money received and falling under the exempted category of deposit, can it be converted into paid up capital by allotting shares in the company? So share application money has not been received, it has been received as a exempted deposit, so exempted category of money. Say for example intercorporate loans, it has been received by the company and later on they want to convert into equity. Is it allowed?
So I think in answers to some of the questions earlier, I had mentioned that to my mind there is nothing wrong in using pre-existing money lying with the company for allotting securities. But people were actually reading section 42 to actually mean that money should come afresh, and that money already lying with the company cannot be used for allotting securities. To my mind, that's a narrow and unduly narrow interpretation of section 42. When money has to come, the money has to come into separate bank account. If money is not required to come at all, because the money already is there with me, to my mind there is nothing that stops the company from using existing money.
Whether a scheme of monthly investment by jewelers fall under CIS? Do require registration.
I think jewelers are, I am sure the queries must be a female. Right. So the jewelers continue to come up with these schemes. Initially when the Companies Act 2014 rules came, I noted that most of the jewelers had actually stopped these installment schemes. Now it seems they are back in action again. Probably they are back in action because somebody has given a legal opinion that these schemes are still not deposits. As is mostly the case, RBI mostly becomes a silent spectator. They continue watching. Until things become very wrong, they just continue watching. When things go very wrong, then they go prosecuting. They don't normally try to stop people from doing something, they just prosecute people for doing excesses. So in case of jewelries, CIS actually is basically what? CIS is actually commingling of, pooling of money. If money is being pooled from several people to invest in jewelries, that's when we say that CIS. If money is being taken individually, we are not even pooling them, we are not even commingling the money. Aman's money and Mr. Pandey's money are not being commingled. It's the same entity getting the money, but the money is being received from several people. Individual. So less chance of this being a CIS, more chance of this being a deposit scheme. I think the penal consequences of Companies Act are even more stiffer than the CIS consequences, because this one is
non-compoundable.
Several years in jail plus a fine and non-compoundable. Please do appreciate non-compoundable sections. The only way to handle the prosecution, if at all filed, the only way to handle will be to appear in courts.
Yes.
So you will be charge sheeted, then you have to go to criminal court, appear there personally first. Then your lawyer goes and says that he gets exemption from personal appearance, which the court may not grant. If the court doesn't grant the liberty of not personally appearing, in that case every hearing you are personally there in the court room with the same band of people who have done all kinds of crimes. So there is no respect for corporate criminals as distinct from other criminals. So this is, I would like to caution that please never get into a situation where you get into a non-compoundable offence. We'll all be happy paying money and getting rid of an offence, but handling a criminal prosecution in magistrate courts will be quite indignable for most of us.
Revolving fund received from section 8 company from any company or trust, whether it will be treated as deposit. Revolving fund generally company receive for the purpose of giving awards or any other things.
Section 8 companies are not for profit companies. Section 8 companies getting deposits from their members, and the purpose is clear that the money is coming as a deposit, security deposit. I see no problem in that. If the money is coming as a financial facility, I surely see this is a case of deposit. There is no exemption from deposit rules for Section 8 companies. So Section 8 companies are as much covered by deposit rules as any other company.
I want to repeat one question again. In case of construction contract, the flat is delivered after 3 to 5 years and the contractor developer receive consideration. Since the flat is handed over beyond 365 days, whether amount beyond 365 days become deposit. Second question related, if a real estate promoter receive advance against sale of flats or it takes more than 365 to deliver, will it be treated as deposit?
So I think my answer is still the same, and I had mentioned earlier as well that for me the magic word is not 365 days. The magic word is whether money was collected for a specific ascertainable contract, or was it generalized funding and we never know what to do with the money. So if money is received for booking of a flat, and the idea is actually to deliver a flat, idea is not to return the money, idea is to deliver a flat. It's in order to become a deposit, it has to be a money for money transaction. In this case it was money coming in, a flat going out, not money going out. So the question of this amount being taken as a deposit at all would not arise in the first place, unless you are operating this scheme to basically as a disguised deposit scheme. Like a lot of people I know in the property sector, they raise so-called loans and they allot a flat today. 12 months later they cancel the allotment and return the money.
Yes.
So
Circumventing the law.
So this is basically what, as we earlier mentioned, that please do bear in mind that deposit regulations have to be complied with in substance, not merely in letters of law. So substantively, if you are adhering to deposit regulations, not taking money for money transactions, I don't see a problem at all.
Excess money received as deposit kept in separate bank account and then transferred to separate FD account, and can the loan be taken from the bank on the separate FD account? So receive the deposit, parked in the account, and thereafter from that account taken the OD limit. Is it possible? Interesting question.
So basically what is therefore, I think if I were to change the question a bit, I might also say that somebody places FD in a bank. It's not my money, somebody else places FD in a bank. Against that FD, the bank gives a loan to me. The bank has a lien on the deposit. So normally
I think these are practices which exist, but if you examine the practice, this basically means what? Bank is giving a loan to X for deposit placed by Y, and there is as such no connection between X and Y. So why would Y, who has placed the deposit, encumber his deposit for a loan to be taken by X? If the bank is doing any such lien marking, the bank will be called upon to answer to the RBI as to how could money placed by an unrelated person be used for giving a loan to a completely stranger person. I think it would be completely a questionable practice, not merely from point of view of deposit regulation. I would say even as banking practice, it's highly questionable according to me.
Exemption to deposit, as rightly advised by you, sir, on appropriation within 365 days, it does not happen. There are outstanding as on the year end 31st March. What are the disclosure to be made in terms of compliance?
I think we had plenty of questions on this 365-day phenomenon, and I had expressed my view, and I'd just like to repeat my view once again.
I think question is just relating to if money remains outstanding,
So
then what are the compliances or disclosure is required, not compliances, disclosure.
The first issue is, when the money was taken, was it taken for a specific supply was it taken for a specific commercial contract? If the answer to this question is yes, there was a definitive specific contract, and the idea is in spirit to use the money for supply of that particular contract and not for returning the money. In that case, the money stood appropriated on the very day the money was taken. 365 days is therefore of absolutely no relevance, because appropriation was done on the very first day. So on the very first day the money stood appropriated. Now when do you actually supply goods, or when do you actually render services? That's a separate question altogether. As I mentioned earlier, my understanding is not the limit on supply of goods or services, the limit is on appropriating the money, which would mean if the money was appropriated from the very beginning towards supply of goods and services, I don't see any challenge there. Therefore, there is no question of any disclosure requirement if the money was against a specific contract. If the money was not for a specific contract, then end of 365 days you must make efforts to return the money.
One question I have asked earlier also, amount taken by the promoters and relative of promoters, whether it will be exempted.
Okay, promoter deposits will be exempted only if the money is coming at the stipulation of lending institutions. Banks or financial institutions which have sanctioned loan, as a term of that sanction, they say that you need to bring unsecured loans from promoters. In that situation only, money coming from promoters and promoters' relatives. Promoters mean what? People who are defined as promoters. Relatives, once again, is definition as per section 277 of the Companies Act. So, A, there is a stipulation from lending institution as a part of its sanction letter. 2, stipulation is that you bring unsecured loans from promoters. Loans are brought from promoters and their relatives. Only in that case the deposit will stay exempted. Otherwise, it will have to be either a director deposit or director relatives or a member deposit.
If amount has been received under 1956 Act, how the company will treat this amount after commencement of this new Act? I think section 74 is the...
In fact, MCA came with a clarification, I think 5 by 2015. Clarification to say that if the amount on the day of its receipt, as per 56 Act, it was not a deposit at all, merely because of change of law, it does not become a deposit. So there is no need to there is no need to do any filing for those amounts which were received under the 56 Act and these were exempted under the 56 Act. That was, I think, one of the clarifications of MCA. But if you read section 74, it goes to say that within 1 year you must return the money. And I think in
1st June was the last date, 2015.
Sure.
Under certain MLM, multi-level marketing modules, direct seller are required to pay joining fees or amount of purchase. Whether joining fees will amount to deposit.
So if there is a larger question on legality of MLMs itself. I think so. If you park that question, for a minute we park the question, we say MLM is perfectly, supposing we say that it's perfectly legal, then the so-called purchasers, they need to pay a hefty entry fee, because the whole MLM structure goes on a substantial entry fee paid at entry time. That is, when you become member, you need to make a substantial cash outflow, and the only way that you recover your outflow is by bringing in more members. So if you pay, for example, 10,000 rupees at time of entry, the only way to recover that will be to increase the membership by bringing in more members. So that money is actually paid for purchase of goods and services, and therefore that money is actually not a deposit. But if this is what is de facto deposit, then the very legality of MLMs will be in question. So I think the larger question surrounds the structuring and legality of MLMs, whether this is actually de facto nothing but a financial money circulation scheme rather than a scheme for sale of goods and services.
Two questions on stamp duty. Whether debenture issued by unlisted company or private company are chargeable to stamp duty?
Stamp duty is applicable on every issue of debentures, and I think
Yes.
I read one of the questions
Yes.
was if issuing demat debentures, if issuing debentures in demat format, is stamp duty is applicable at the time of issuance on demat debenture? There also answer will be yes. Dematting basically means what? That you are getting the debentures dematted by issuing them to a depository participant. There is an issue of debentures that happens to DP, and the DP then credits the account of the debenture holders. So issuance of debentures is still involved in case of demat issuances also. So stamp duty is applicable on every issue of debentures unless exempted. Exemption window, there is a notification. I think several stamp laws say that if there is a mortgage debenture and the mortgage has been stamped already, then there is no stamp duty on the debentures. That's one exemption. Second, not exemption but notification, I think 2005 or 2009 sometime notification of Ministry of Finance to say that the maximum stamp duty on issue of debentures is capped at I think 2.5 crores or something like that. I'm sorry, I'm not sure on the number, but there's or probably 25 lakhs. I'm sure. Sorry, I'm not clear on the number, but an above notification which limits the stamp duty on debentures, or a state provision exempting mortgage debentures from stamp duty if the underlying mortgage itself is duly stamped. So that's the only exemption you can avail. Or non-transferable debentures actually are exempted. If debenture itself is completely non-transferable, then it's not a marketable security, and therefore it might avail the exemption from stamp duty.
A private company which is subsidiary of public company becomes deemed public company as per the definition. So can this company, subsidiary company, issue unsecured debenture to holding company?
For any subsidy to issue debentures to holding company, I think this detailed set of facts was not even required. A subsidy issuing debentures to holding company is an amount received by company from a company. Company to company amount is not at all covered by deposit rules at all. So there is absolutely no problem.
Can CCD be refunded before the term of conversion at the option of the debenture holder?
CCD, as the name implies, compulsorily convertible. There is no way not to convert and refund. It's compulsorily. And that would mean there is neither party has an option of not converting and repaying the money. So CCD is liable to become equity. There is no way of refunding the money.
Can it be brought back, or can the terms may be varied to make it optional?
Well, I can understand what's playing in the mind of the querist. But actually, as CCD, quite often we need to understand, as professionals, we need to understand our job is not to satisfy every wish of our client or our employer. Our employer, our client has a strong wish. मेरे को इंस्ट्रूमेंट डिजाइन करके दो जो एक्चुअली सीसीडी नहीं है लेकिन सीसीडी लगे. My actual idea is not to convert it, but it should look like a CCD. We'll probably have to say there are limits on what we can do. So I would not advise a CCD to have any potential for terms also being amended, because the basic idea of compulsorily convertible debenture is from the very first day, the day we issue, we know for sure that this is nothing but equity or preference. It can be converted to either equity or preference. So it has to be necessarily converted. The question of refunding it will not arise at all, excepting in liquidation.
If a company is required to create DRR but due to inadequacy of profit could not create the same, is there any default under the Companies Act 2013?
Absolutely not. DRR is
in the ability of the profit.
Absolutely. DRR is you transfer money from profits. If the company does not have profits, there is no breach of law. So if, for example, let's say we were required to convert, or we are required to create 25% DRR over 5 years, supposing 5 years is a tenure. So we are required to, let's say, create DRR of 5% every year. If in the first year the company did not have profits, then the requirement will shift to next year. So next year the remaining maturity is 4 years and we still have not created any DRR at all. So it would be 25% divided by 4. Assuming second year also the company does not have profits, in the third year the requirement will become 25% by 3. So on the residual maturity you can create DRR still.
I think time is very less. I will ask last 2-3 questions only. Can conversion date of CCD be extended after its issuance?
Conversion date may be extended. The exemption from deposit rules says that the CCD must be convertible within 10 years. Earlier 5 years, later amended to 10 years. That would mean I can extend the conversion date, but I don't think we should take it beyond 10 years. So convertible, let's say within first 2 years, and then we continue extending, but after extension also we must not stretch it beyond 10 years.
Is appointment of debenture trustee is required in case of OFCD secured issued by a private company? I think this question has already been answered.
I answered that question. I said if it's a secured, it's an optionally fully convertible secured. If it's a secured debenture, then appointment of trustee becomes a logistic necessity, because you are creating security interest in favor of a trustee who holds it in trust for the debenture holder. Even if the law did not require it, we need it from point of view of transferability. The charge would remain with the trustees and the debentures would remain transferable.
I think last question, because other questions are relating to filing and all other things, so I have excluded those questions.
So I must inform everybody, I think currently we have a total of 148 questions, right?
148 questions.
And still counting?
Still counting.
Okay. So that's good. I think the fact that the
purpose of the webinar is achieved, I think.
Is to have lots of questions. I am sure as the institute has done for other similar lectures, we'll probably prepare answers to these, right? And we'll probably also put the answers on the website of the institute, so I think it's available for everybody.
Last question is, valuation certificate is required for issuance of unsecured OFCD in private company? If yes, what is the method in case of OFCD are issued as per the provisions of signed SHAs, shareholders agreement?
So if you are issuing secured debentures and you are fully convertible debentures, it's optionally fully convertible.
Optionally fully convertible.
Fully convertible. The question is compulsorily convertible or optionally convertible. I am assuming the query is probably meant optionally convertible. So if it's an optionally convertible debenture, it is still eligible for the exemption on account of amount received from a company. If it's the other party is not a company, assuming it's, let's say, not a company, in that case for availing exemption you need to ensure the debenture is secure. It has to be fully secure, and for the debenture to be exempt as fully secure, the value of security has to be at least equal to par value. So valuation certificate may be required. Valuation certificate may be required for from two purposes. Valuation certificate in terms of section 62(1)(c) read with 62/3. When you issue of CDs, you are either going under 62(1)(c) because there might be issue of securities in future, or you are going under 62/3, whereas you are talking about a debenture having an option to convert. In all such cases, valuation becomes relevant, because otherwise how do you know what should be the appropriate issue price? So I would say looking at 62(1)(c), 62/3, as also looking at, and another very important provision would be 56(2)(7)(a) and 7(b) of the Income Tax Act. From 1st April 2017, let's read that as 56(2)(10) of the Income Tax Act, talking about issue of securities. So there also concept of fair value comes. So fair value is relevant from several perspectives under FEMA rules of RBI, FDI rules by RBI, 56(2)(7)(a) and 7(b) of Income Tax Act, 62(1)(c) and 62(3) of Income of the Companies Act, and of course valuing the securities in case of fully secured debentures. So from several perspectives, valuation becomes relevant. I would therefore say valuation is important.
Want to say something concluding?
So it's been fairly interesting, I would say. I was actually expecting, interaction, and interaction did happen, and happened largely to my satisfaction. And I must also say that the number of people who were logged in is also immense, and that also, I must thank you all for, it's a working day and these are working hours and peak working hours, taking time out of peak working hours, particularly on a Friday,
I think it's really requires dedication. So I thank you all. There are 2,800 numbers who logged in. So that's really commendable. And I've got more than 150 questions. That's also commendable. So it's been fairly interesting. I must apologize for my little bad throat, for which I couldn't actually speak as loud as I actually can. But I hope all of you were able to hear me. Thank you all very much.
Friends, thank you very much for your as Kothari ji has already explained that working day, and that too Friday, it's very taxing. It must have been very taxing for you to attend this webinar. But definitely knowledge is one thing that we should always disseminate, and we thank you Mr. Vinod Kothari for disseminating important information and knowledge in regard to deposits and debenture. I really appreciate the way he has explained everything. Really commendable, sir. And I think you have taken the repetitive question. I have asked 365 days question at least 5 times.
Good, and you didn't ask 365 times.
and amount held in trust question at least 4 times. So you have not get irritated by answering the same question again and again. Friends, we have tried to answer the questions. We have received total 150 questions, and we are able to answer 130 questions. So around 18 odd questions or 19 questions has remained unanswered. It might be possible that those questions are repetitive in nature. That is why I have not taken it. But rest assured, we will definitely come out with the FAQ. We will send it to the all the questions to Kothari ji, and he will compile the answers, and we will host these FAQs on the website of ICSI, and it will be shared through the link also to, through a mailer to the members. So keep participating. We are getting motivated by your participation in these webcasts, and surely next time another interesting topic will be coming under the Companies Act only. So thank you very much for your patience. Thank you very much for your participation. And as a matter of token of love and appreciation from ICSI, I request Mr. Alad Rao, Central Council member, to kindly come and present a flower bouquet to Mr. Vinod Kothari.
Nice surprise. Thank you very much, sir. Thank you very much.
Geo green concept.
Excellent. Thank you. Excellent. I'll definitely carry this along. Thanks. Thanks a lot.
Thank you so much, sir. Thank you.
Thanks very much, Sanjeev. Thank you very much.
Thank you, sir.
Thanks.
Great session.